Okay, good morning, everyone from New York City. This is Adam Ring from First Finance Institute. Happy to be with all of you from New York City on this December morning. For those of you, just to clarify, we are in a 1 hour long Excel webinar to go over some key financial formulas for Excel that will be helpful for various forms of financial analysis. In a few minutes, I'm going to kick it over to my colleague, Shelly Lombard. Hey, Shelly.
Hello.
And Shelly is going to be leading the presentation. She's going to be off camera just because it makes the presentation a little bit easier. But wanted to introduce Shelly. She is one of First Finance Institute's great instructors. She's a visiting teaching fellow at UNC Kenan-Flagler. She leads a lot of the instructional design for our programs with Columbia Business School and Wharton School at the University of Pennsylvania, and I'm sure you'll enjoy her presentation. And just a quick note before we kick it over to Shelly, I know we have some people today who are involved in some of our programs, but for those of you new to us, at First Finance Institute, we run executive online certificate programs with the top business schools in the world, whether it be Columbia, Wharton, UNC Kenan-Flagler, HEC Paris, or IE Business School in Spain. We do have two upcoming programs I should mention in English with Columbia Business School. One is M&A at Columbia Business School, and one is ICCF at Columbia Business School. ICCF starts on March 3rd of 2020, and M&A will start on April 20th of 2020. You can find more information at our First Finance Institute website. Both programs are really good. If you like today's session, I'm sure you'll enjoy those programs. You can learn more about those programs and sign up on our First Finance Institute website. And we're actually, timing is still a few more hours. We are having a promotion of $300 off sign up for both programs. So if you do sign up by the end of today, I believe, you can take advantage of that. If not, you'll have until those respective start dates to register. So with that out of the way, it's happy, again, appreciate everyone joining us today. Hopefully you'll find this session useful, and I will kick it over to Shelly for her presentation. Thanks, Shelly.
Hello, everyone. Let me give you 1 minute on my background. Some of you may have seen, if you're enrolled in one of the courses, I usually, in the introduction, say a little bit about my background, but I have an MBA from Columbia, and I went into Wall Street. I was a journalist before Wall Street. So I didn't know anything about anything financial. And then I went to my first job out of business school was doing leverage buyouts at Citibank. And it was a great time because there was deal after deal after deal. It's kind of the heyday of leverage buyouts, and we had to build all our own models. So it was a great, great learning experience. And then I went from there to what's called the sell side, sometimes the buy side. So I worked at hedge funds, either investing money. My specialty was highly leveraged companies, either high yield bonds or distressed bonds or value equities. And then sometimes I was on the sell side. So I was also a high yield / distressed bond analyst when the auto industry kind of cratered in, the mid 2000s. And I covered General Motors and Ford and all the suppliers, et cetera. So anyway, that's kind of my background. I am by no means an Excel guru, but some of the formulas I use a lot more than others, but these formulas are kind of, designed to kind of do what, what the kind of work that you and I do, financial work. And so your work is probably similar to mine. So we picked formulas in Excel tools that are probably helpful in that kind of work. But, if you ask me other things about Excel, I'm definitely not an Excel guru. And I probably only tapped into, 5% of what Excel can actually do. So you're free to open an Excel file on your computer and follow along with me. I do a couple of examples. And so if you have questions as I do the examples and your numbers are not coming out the same, then, you use that as an opportunity to ask questions. If I don't cover something or you don't get a chance to ask questions, then feel free to connect with me on LinkedIn and just shoot me a question, shoot me a message, and I'll try to answer it as best I can. Again, I'm not an Excel guru, but based on the kind of stuff that I've done in my career, I have certain formulas that I know pretty well, and I'm happy to share that. So let's get started. So these are all the things we're going to go over: present value, IRR, future value. We're going to go over some bond formulas, and then end with data tables and goal seek. So let's start with the basics of present value. And, I took what's called the baby finance course at Columbia. Everybody starts with what they call baby finance. And I was a journalist, a writer, and I could not get the concept of present value for anything. I was like, what are they talking about? $1 today is worth more than $1 in the future. I just didn't get the concept behind it. We're not going to go over it conceptually, because I'm sure most of you are better off than I was when I entered Columbia. But just in terms of using the Excel formulas, that's what we're going to go over today. So this is one of the basics. It's a present value formula. And the nice thing about Excel is if you put in equal PV and open parens, it'll tell you what you need to input. So that line that I have equals PV, rate, NP, etc. Excel is basically prompting you and telling you what you have to enter. So it's easy as could be. Just a couple of notes: the rate is the interest rate. So that's the rate in the market. And a lot of times when people are doing PV on something that pays a coupon, then they want to enter the coupon there. But rate always refers to the interest rate, always refers to the interest rate in the market. So if it's a bond that pays a 10% coupon, but the interest rate in the market is 12%, the rate is 12%. NPR is the number of periods. Payment is the amount of the annuity payments in dollars. So that 10% coupon, you would enter the rate. If the rate in the market, the prevailing interest rate in the market is 12%, you'd enter 12% for the rate. But the payment on that 10% bond is $10 if the bond faces 100, 100 if the face is 1,000. That's where you enter it in dollars, but without the dollar sign. The future value is optional. The default is 100 cents on the dollar, but you don't have to put that in. And then the type of payment is whether the payment's made at the end or the beginning of the period. Most of the time in finance, we assume the payment's made at the end of the period, so that's the default. But the beginning of the period is you can change that. If you put in 1 where it says type, which is optional, then Excel will assume that the payment is made at the beginning of the period. Present value is useful for annuities, equal payments, and it's useful for lump sums. So for an annuity, you would put in, like I did with the bond, a 10% bond on the $1,000 face. That's a $100 payment. You put in just 100 for payment, and what you're assuming is equal payments of 100 over the life of the deal. But for a lump sum, say you're looking for the present value of a lump sum in the future, you would put payment in as 0, and you would absolutely have to have the future value, because you need something, either the payment or the future value. So in that case, if you're doing a lump sum, future value is not optional. Couple of things: the rate must be in decimal form. So I've made mistakes before and put just like the payment in, you put it in dollars without the dollar signs. I've put the rate in as 12 instead of putting 0.12. And I get this answer. Sometimes you get an answer that makes sense, but it's wrong. Sometimes you get an answer that intuitively is wrong, and you can go back and correct yourself. But just make sure of that. You can either put the payment in as 0.12, or you can put it in, if you've configured your Excel to have that cell be a percentage, you can just refer to that cell, which is what I usually do. But make sure the rate is in a percentage, either a decimal or referring to a cell that's in percentage form. Just one thing that always confuses people: the answer is going to be negative. And that's because what you're doing is Excel is assuming you're paying out today to get money back in the future. So one of those has to be negative. Either your payment out, like you're buying the bond, is negative, and then all your coupons and what you get back at maturity is positive, or you can put the payment in as positive, and then all your cash flows that you're going to get will be negative. But they can't all be positive. So typically people, assume that your payments, you're getting in your coupon, and that, your payments are positive. And so therefore your answer will be negative. That's what you're paying for the investment. And then you need to adjust if the payments are something other than annual. And we'll talk about that in a minute. We'll do an example of that. So here's a simple example. What's the present value of an annuity payment? $7,000 a year, paid each year for 4 years, and the interest rate in the market, the prevailing rate is 6%. So equal PV, open parens, Excel will prompt you put in 0.06 for the rate, 4 for the number of periods, the payment is 7,000, and you get the answer there around 24,000. And this is the way to check it. If you're used to doing your present values the long way, here's just a chart which shows that it, obviously comes out the exact same way. And sometimes when I do the PV formula and I'm not sure I'm right, like for some reason I think something looks weird, I'll go through and do this. But obviously this is not really practical when you have a long stream of payments. You can do it if you're doing a discounted cash flow and you're going out 10 years, but if you have a 20-year bond, doing something like this is not really practical. So there are a 20-year stream of payments. So that's why the PV formula makes a lot of sense, because you certainly can do this, but it's just a little bit of, it's more work than just typing in equals PV. Here's one for a lump sum. So what's the PV of $50,000 paid 4 years from now? You're getting no coupons, no payments in the interim. The prevailing interest rate is 6%. In that case, equal PV, open parens, 0.06 is the rate. The number of periods is 4. The payment is 50,000. I'm sorry, the future value, payment is 0. The future value is 50,000. So in this case, you need to put in the 0 for the payment, and you must put in the future value, else Excel has nothing to work with. You don't have to put in the type, that's optional. And the future value, the present value is 39,000 and change, and then the check is right there. That's how you would do it if you were quote unquote doing it the long way, which is what we did in business school. I had a really tough professor, baby finance professor. He was excellent. And so I learned to do it the long way. So net present value is a little bit different. I'm going to go to this side first. It's useful for a series of cash flows that are unequal. So the problem with present value is that the cash flows, it assumes, if you look at the formula, you can't put in different payments. But net present value, you can use it if 1 year the payment's 20,000, the next year the payment's 15,000. So if the cash flows are unequal, they're not an annuity, net present value is the way it should go. The rate should be in decimal form, same thing, 0.10, not 10. And it's a really simple formula, equal NPV, open parens, you put in the rate, and then you highlight all your values, all your cash flows, close paren and enter, and you're done. That gives you, though, the net present value of the cash flows. You still have to subtract the investment. Now, and that needs to be subtracted separately. And sometimes I still do it because I don't use NPV a whole lot, but I will put the investment in as negative as my first cash flow and then put all the positive cash flows. The problem is that investment is paid up front in the first period. So if you put it in as the first cash flow, it changes your NPV, because what Excel is assuming is that it's being paid at the end of the period. So you're going to get a very different number. So basically Excel's NPV is just really a PV of uneven cash flows. That's all it really is. You have to go in and subtract the investment separately. If you don't, then you're going to get the wrong answer. So make sure you do that. Because I was doing it, just a few days ago. I'm like, why is this not coming out right? And that was the reason. So back to the formula, NPV, rate, highlight the values, close parens, hit enter. Easiest thing in the world. Just remember to subtract the investment, which you're actually paying to get that stream of cash flows at the end. Don't put it in the formula. And here's an example. So what is the NPV of an investment that requires $250K up front, then generates these following cash flows? And the required return is 10%. And so you put in the 0.1 for your required return. That's the market rate of return. That's the rate of return your company demands on the project. You put in the string of cash flows, and I put these in for purposes of you seeing them. But if you look at Excel, if you're using Excel, you wouldn't put the commas in, the 100,000. You would just, you'd probably enter your cash flows. Maybe you would format them so they have a comma, but you don't actually need to put the comma in. So this would be, just 100,000, 150, etc. Sometimes those little things on Excel will trip you up. So again, don't put the comma in because Excel won't recognize it. But what you do is you put the numbers in, and then if you wanted to make it look pretty, you just format it so that there's a comma in it, and Excel will then read it the same way. And then again, you subtract out the 250 at the end. So that's net present value. This tends to be used much more for project kind of work. So in other words, we're looking at a project, we need to invest 250,000 to get this plant up and running, and then these are the cash flows we expect over time. And so if the NPV is positive, that means the project generated more in cash flows than it cost us to invest in it. And so it's a good investment. The problem with NPV is, so you theoretically are supposed to invest in anything that has a positive net present value. In other words, the value of the cash flows, the present value of those cash flows is greater than the amount that you're spending to create those cash flows. But it doesn't tell you what the return is. It doesn't give you a way of comparing two positive NPV projects. And so that's why we go to the next thing. Actually, we talk about IRR in a minute. Sorry, future value first. So future value, opposite of present value. Another thing that confused the heck out of me when I started out in business school is basically, equals future value, again, open parens, and Excel will tell you exactly what you need to supply. So again, rate is the prevailing interest rate in the market. Number of periods, the payment per period is the dollars of that annuity, obviously without the dollar sign. Present value of that annuity is optional because it's in brackets. So I don't think I said if it's in brackets like PV and type, it's optional and you don't have to supply it. And so with PV, I don't think that, I think I have a typo here. The default is not 0. There's just, it's rate, number of periods, and payment. You don't have to put anything in there at all. And I won't say the default is 0. And then the type, the default is 0. So take that out, scratch out default is 0. You just don't need it. If you're doing present value, you don't need to calculate it. There is not necessarily a default. But type, there is a default. This is useful for annuities, same thing as present value. The payment has to be equal payments. So, but for a lump sum, you put the payment in as 0, and PV is no longer optional. You need it because you're calculating the future value either of a stream of payments or a lump sum. So you need one or the other. Again, the rate should be in decimal form. I've made this mistake several times and got something that didn't make any sense. The answer, again, just like with the PV, will be negative. So it's going to be the opposite of what the payment or the PV is. So if you put the payments in or the PV in is negative, then your answer is going to be positive. And again, we'll do one in a minute that adjusts for semi-annual payments. So here's one now. What's the future value of an investment? $2,000 a month for 5 years, given an annual interest rate of 5. So this is $2,000 every month. So what you need to do is adjust that interest rate, 0.05 divided by 12. So that's bold. And then you need to adjust the number of periods. It's 5 times 12, not 5. And then you put in the 2,000, and that gives you the future value of that investment. So that's how you would adjust if it's a payment that is not an annual payment. Let's look at another example of that. The future value of $10,000 invested for 3 years at an interest rate of 8% compounded quarterly. So 8% is, the prevailing interest rate. That's divided by 4 because it's compounded quarterly. And then the number of periods is 3 years times 4 times a year. And then you have the $10,000 and you get your future value. Internal rate of return, I use probably more than any of these. I use IRs, I won't say every day, but every time I look at an investment, I look at it, I use an IRR. Even though, because if you look at a stock, you look at something, you go, okay, if I buy it at 4, I'm valuing it based on, what I think EBITDA will be, next year or 2 years from now, what the forward multiples are in the market. I'm buying it at 4. I think it'll pop up to 7. What's the IRR? So I use that all the time. I also use it for bonds because a lot of times with distress, the bond's not going to go to maturity. It's going to be restructured before then. So I want to look at an IRR because I'm not holding it to a yield to maturity. So the yield to maturity is irrelevant to me. I'm holding it till I think something good will happen with the company and the bond will pop up, in which case, and it may not pop up to par. It may pop up to, I might buy it at 65 and it might pop up to 80 and I'm happy. I'm not waiting for it to go to par. So a lot of times I use the IR. I very seldom do a PV or do a yield to maturity just because that they're not relevant in the world that I inhabit right now. So the internal rate of return is also preferable to NPV. Not preferable, but it tells you the return. So if 2 projects have a positive NPV, which one is more valuable? And you can look at it and say, okay, on an absolute basis, this one has a positive NPV of 10,000. This has a positive NPV of 200,000, but you haven't got the sense of the cash flows and that kind of stuff because maybe, on a weighted basis, just maybe one project is still preferable for some reason. So IRR gives you an actual return. And so you can kind of compare the projects pretty much apples to apples. So you input the values. This is the easiest thing in the world, which is why I like it. I don't have to think about, putting in the rates as a decimal point rather than as a payment. It's you put equals IRR, you open parens, you highlight the values. I never make a guess. I don't bother. I close parens and I hit enter, and that's the end of it. So the answer tells you what return you earn on this project if it gives you the following cash flows. The first period cash flow is negative. But the answer to an IRR calculation can be unreliable if there are multiple negative cash flows. So if you've got, it's understood that the first cash flow is negative because you're putting out money for the investment, but the rest of the cash flows should be positive. I think you can do an IR if the cash flows fluctuate between positive and negative. I won't say the answer won't be right, but I don't know if I would rely on that answer. So I try not to use IR for that. And to tell you the truth, I don't know what you would use, but if anybody has that question, they can, shoot me a message or something. I think there's something called modified IRR. If anybody knows anything about that, please volunteer during the Q&A. But as far as I know, straight IRRs, if you have a lot of, the values, if the inputs, the values fluctuate between positive and negative a lot, I don't know if I would rely on the return that I get. IRR also assumes that all the periods are equal. So, they're all annual or they're all monthly. And so that sometimes is a problem for me with IRR, which is why a lot of times I use XIRR. XIRR allows you to put in values and also dates so that the periods don't have to be equal. So sometimes with a bankruptcy situation, I'm collecting a coupon, which is semi-annual, but then when the company goes bankrupt, it may not be the bankruptcy might last seven months. So the periods are not 6 months, then I have a 7 month. I have a recovery in bankruptcy after 7 months. I get my money back or some of my money back. And so XIRR really takes care of that. It's useful if the periods are not equal. You input the values, you input the dates. I would use the date format for dates, so Excel will recognize it as a date. So I think even if you put it in as, what's the date, 12, 19, 19, I think if you just put it in like that, I'm not sure if Excel recognizes it, but you just go up to the top, you click date, and I put it in so it looks pretty. It's the how hyphenated thing, which you'll see on the next slide. And it's easy peasy. Equal XIRR, you highlight all the values, then you highlight all the dates, and you hit enter. So here's an example. I buy a distressed bond that pays a 10% annual coupon. I buy it for 65 cents on the dollar. So it's a $1,000 bond. I'm paying $650 for it. And I recover 80 cents on the dollar after 17 months in bankruptcy. So again, the periods aren't equal. And I probably could have made it more complicated, but the cash flows are, money going out the door on January 15th, 2020, and then I collect 2 coupons. The company gets into trouble, they default on the bonds, and so I get no coupons for the next 6 months period. But then after, 17 months, I collect $800. I don't get par back because this is a distressed company. I'm lucky I got anything back. I get $800 back, and this gives me my IRR. So the XIRR is something that I use a decent amount of times, because a lot of times with distress situations, the periods aren't equal because you're factoring in, you can use the zeros in IRR. I do that all the time. So I'm going for, I could have done an IRR on this, except for this bankruptcy period wasn't 6 months, it was 7 months. So I couldn't really use a regular IRR for that last, because that last period was more than 6 months. So XIRR is something that I use a fair amount. So the next thing we're going to talk about, these are really bond formulas. I don't use them a lot because I do a lot of distress these days and a lot of value equities. A lot of it's IRRs in particular, sometimes XIRR, but rate is really helpful. And to tell you the truth, I don't know of any other way. If somebody else knows, great, let us know. But to calculate the interest rate on, this is basically, you're not calculating the present value or the future value, you're given that and you're calculating the rate. And I don't really know of another way to do it. That's definitely not one that's easier than this. So it's used to calculate the interest rate per period of an annuity. So number of periods, the payment, this is the PV, and I'll tell you what, Excel will tell you what interest rate you're getting on it. The PV must be negative, because if not, you're going to get a number error. So in other words, just like before, you can't have both the PV and the future value positive. One of them has to be cash flow out the door. And so in this case, the PV should be negative. If not, you're going to get, and I always get confused with the Excel errors, like, some of them are hashtag num. I think they're hashtag a couple of other things, but this one will give you a hashtag num error, which means one of the numbers is wrong. If it's not annual, then you need to adjust the number of periods, the payment, and the answer. So let's look at an example here. So I like to set it up this way because I can use it for a lot of things. I just change the inputs. So this is a bond that has 5 years to maturity, 2 coupons a year. This is a U.S. Bond, annual coupon of 5%, and the price of 102, and the future value is 100. So you're buying at a 102, but you're only getting par back. So what you would do is, and I like to set it up this way because then I can just go plug things in, the rate is basically the number of years to, the number of periods. And so it's equal rate is a formula. You open parens and Excel will tell you what to put in. The number of periods is basically the years to maturity times the coupons per year. And then the payment is that 5%, but remember that's supposed to be in dollars. So it's the 5% times the face of the bond. It's not times the price of the bond, but it's times the face of the bond divided by the number of coupons per year. So in this case, it's basically 5% times the par, which is what we use, the word we use for face value, the bond, divided by 2. And then you put the PV, which you're paying for the bond, in as a negative number, and that's negative 102. And so in my chart, I set it up as a positive number. In my formula, I put the negative sign in front of it. You can do it either way. And then the redemption value or the par value of the bond, and you don't always get par back at redemption. I know that because I do distress, but in this case, regular bonds, you're supposed to get, unless they default, you're supposed to get 100 cents on the dollar back. So that's back. And then the type is 0. And that means that it's, oh, I'm drawing a blank on what 0 means. But at any rate, hold on one second, let me just look here. And that's the type, oh, that's the US, I think. That's the way the US calculates, because the next one I think is, oh, nope, that's the European convention as well. Let me get back to you. I've just had a brain freeze and forgotten what the 0 stands for here. And that's an optional. That's type. It's not guess, it's type, because I've never provided guess. It's just not even worth the time to provide the guess. And so, because that Excel's supposed to make my life easy and not vice versa. So anyway, I never provide the guess, but let me remember what the 0 is for in terms of type. And then you get the answer, and then you have to multiply that times 2. So this is the adjustment that you make when it's a semi-annual payment, which is typical in the US. The next one is the European convention, where it's 1 coupon a year, an annual coupon, and you don't have to make all of those adjustments. The number of years to maturity, which is 5 years, times the coupons per year is just 1. So, you know, it automatically gives you 5 instead of giving you what you got in US, which is 5 times 2, which is 10. The annual coupon is basically 5% times the face value of the bond, but it's divided by 1. So you end up with 5. And then you get the negative 102, you get the 6, which is C6 is the face value of the bond, a par. And there's a slight bit of difference under the US convention, which pays twice a year. The answer was slightly higher, and that's because of the value of the compounding, because you're getting that, you know, 2.5 coupon 2 times a year, and you get a little bit of interest on that coupon rather than waiting to a full year before you get a 5% coupon. You're getting 2.5, you get some interest on that, then you get another 2.5. So the yield is always going to be slightly higher if you're doing the semi-annual compounding. So calculating the price of the bond, and I use this instead of using PV to calculate the bond. It just makes it a lot easier because you can put in the settlement date, which is the date you buy in the bond, and the maturity date and all of that, and it just makes it a lot easier. This and the previous one, rate, are just wonderful Excel functions to use. So the settlement date is the date you buy the bond, then you put in the maturity date, the rate, and in this case, which is a little bit confusing, remember with using these bond Excel calculations or these bond Excel formulas, rate is the coupon. So when we were using PV and using future value and also IRR, the rate was the prevailing interest rate in the market. But with these bond ones, price and rate, the rate is the yield in the market. I'm sorry, the rate is the coupon. The yield is the yield in the market. So it's a little bit confusing maybe, and that's why sometimes I flip-flop them and get them wrong. But for equal price, when they ask you for the rate, they're asking you for the coupon rate. And then yield is the rate in the market. So it's different than what it was when we do in present value. So you supply the settlement date, the maturity date, the rate or the coupon, in this case 12%, you supply the yield, which is 10%, and then you supply the future value or the redemption value, and then the frequency. And so the coupon frequency, this is where you differentiate between a US bond and a European style. And the basis is the day count, and that may be what it was in the, that's what the 0 is, I think, in rate as well. It's the day count. And so the 0, and I'm drawing a blank right now, but the 0 gives you the day count. It differs in Europe and here, and I think the next one I have, I have a day count difference. So Excel, if you put equal price and you open parens and start putting all this stuff in, then it's going to tell you when you get to the last thing, it's going to give you options for a day count. And I won't go into it because I'm not really a real technical bond person, particularly the difference between the US and Europe, but the day count I think the 0 is the US function, the US standard of counting days. And I think what happens with coupons, sometimes coupons, and I'm reaching way back into my memory here, coupons, in some countries, they're calculated on the actual number of days in the month and in the 6-month period, or, in the 6-month period. And then sometimes they'll calculate, there's something called the 30-360 convention, where the assumption is that every month has 30 days. So Excel is actually going to ask you what basis you want. And that's what I couldn't remember in the other one, because I don't usually use it. But the day count, they give you, I think it's 3 or 4 different options, and I usually use 0. I think, hold on one second. Yes, and the basis is optional. So that's another reason why. Hold on one second. And I think type is the same as basis, I'm pretty sure. Yeah, I'm pretty sure type in the YTM is the same as basis in the price one. And so Excel will present you with some choices, and I usually either don't put anything, or if I assume anything, I put 0, because that's the convention that we use in the US. And so this gives you the price of the bond. It's similar to a PV function, but it allows you to not use equal periods, because you're buying this bond in April, and then in this case it was pretty close, because you're buying it in April, and it matures in March 31st. You're buying it April 1st, it matures March 31st. But if you were buying it like April 17th or something, and the maturity was March 31st, a number of years from now, then that could give you a problem in using present value. Maybe you could do an XIRR, but why even bother? This is the one to use. It's equal price. And here it is with the European convention. So if you notice, my basis in this one is 4. And again, I can't remember, I'm drawing a blank on it. I don't have an Excel file open, but they give you obviously 4 options, and you pick which one you want for your basis. Like I said, I usually don't choose any, and I think the default is the one that we use in the US. So again, here's another one. Same setup, the only thing that's different is the coupon frequency is 1 instead of 2, which is typical in the US. And this gives you the price of the bond, a bond trading in Europe that has an annual coupon. So the last couple of things I'm going to go over are goal seek and data tables. So a lot of times people always ask me, do you use DCF or do you use multiples? I use multiples most of the time, because a lot of times in distress, what you're getting is you're buying a bond that in bankruptcy is going to be converted to equity, because a company, if it could handle all this debt, then it wouldn't probably be bankrupt. So you're usually buying bonds that will be converted to equity, and most equities trade as a multiple of earnings or multiple of EBITDA something. So I tend to use multiples, because I know the currency that I'm getting once I exit bankruptcy is going to be valued on a multiple basis. But you can do DCFs, as a lot of people do them as a sanity check, or they use DCF period, and they don't use multiples. So let's say you're doing a discounted cash flow, and you've done your terminal value, and you've done a terminal value as it should be done theoretically on a perpetuity. And really, if you're using a DCF, you really should do the terminal value. Some people do it, use a EBITDA multiple, but your terminal value is 50% or more of your DCF value. So really, if you use a multiple for your terminal value, you might as well just use a multiple for the whole thing. So the purists say, do the DCF on the cash flows, in years 1 to 10, and then, you do a terminal value based on a perpetuity. So here's one where the terminal value is 133 million, based on a perpetuity. Then that same company, we did a terminal value based on I'm sorry, I haven't gotten to that yet. So this is the sanity check to take the terminal value that was based on a DCF and divide it by the final year EBITDA, and you get an implied EBITDA multiple. And this is a good sanity check to do, because basically what it says is, look, I've come up with this terminal value, but if I was doing the terminal value based on a DCF, what does this terminal value imply? It implies this terminal value that I've calculated using a perpetuity method, it implies that the exit is at a 5.6 times EBITDA. So you can kind of use that as a sanity check versus where things are currently trading in the market or where you think they're going to be trading, 10 years from now on an EBITDA basis. But you also use it as a sanity check against your EBITDA calculation, your EBITDA terminal value. So say you've done your DCF, and the implication for your terminal value is that your enterprise is being valued at 5.6 times EBITDA. Then you do a terminal value based on a multiple. So you take the final year EBITDA, you think the multiple is 7.5 times because that's where things are trading currently in the market. So the terminal value is 178. Now there's a disconnect there because basically your DCF is assuming that the exit, you can sell the company at the end of 10 years for 5.6 times EBITDA, and your terminal value using your EBITDA, you're using a 7.5 times EBITDA. And so there's a disconnect there. Typically the multiple might go down, not up. As companies mature and growth slows, which is really the perfect, situation to use a DCF, you shouldn't be assuming, and maybe, companies are currently in that industry trading at 7.5 times, but the market sees 10 years from now, maybe it's a Netflix, maybe it's an Uber, maybe it's something like that, that growth will have stabilized and the company will have matured 10 years from now. And so the right multiple really is 5.6 times. But either way you spin it or justify it or think about it, there should be more of a connection between the DCF, the implied multiple that you got when you calculated terminal value based on DCF, and the EBITDA multiple that you're using when you exit. So goal seek is helpful because what you've been able to do in this one is sanity check your DCF that was based on your terminal value that was based on the DCF. And find out what EBITDA multiple is implied. What you'd like to do is look at the terminal value that you got using an EBITDA multiple and figure out what growth rate is implied. And so goal seek helps you do that. So you go to Excel, it's data, what if analysis, and goal seek. And they give you prompts. It's a little table. So set cell, you refer to the cell that has the terminal value based on DCF. And then you have to manually type in the terminal value based on EBITDA multiple. And then you say by changing cell, you refer to the cell with the DCF growth rate. And I think I have an example that I'll show you in a minute. So basically what you're saying is take the cell that has a terminal value based on DCF and make it equal to the cell that has a terminal value based on EBITDA, and do that by changing the cell that has the DCF growth rate in it. And what that does is it says to you that if you want the terminal value based on DCF to be equal to the terminal value that's based on the EBITDA multiple, what does the growth rate have to be? And so in this case, the growth rate is 4.9%. That's what's implied in your terminal value that's based on the EBITDA, which is obviously much higher than the growth rate you actually used for your perpetuity method. And so there's your disconnect there. So goal seek is very helpful. You can use it for a lot of things, but I've used it to do this work and to say, okay, you know what? This 7.5 times multiple is implying that the company is going to continue to grow. Cash flows are going to continue to grow at a 4.9% rate. And that probably is too high, in which case my 7.5 times multiple, exit multiple, is probably too high. Or maybe, the growth rate that you use for your perpetuity method is too low. So either way, you kind of have to think about that, and I won't say justify it, but think about what that means for your valuation and kind of make it consistent. And the last thing we'll talk about is data tables, which I use. Other than IRR, data tables I use more than anything else. So let's say you have the purchase price of a bond, you collect a coupon for 2 years, and then you have a recovery at the end of bankruptcy of par. So, you get 100 cents back on the dollar. And so the IRR is around a little under 8%. So what you would do, you could set up, so what you want to figure out, and I do this all the time in distress, because what you're trying to figure out is bond prices change all the time. So in this case, the bond price was 95, but tomorrow the bonds could be offered at 98. They could be offered at 72. So what you want to do is set up a table that tells you what the return would be if the bond price changes. So you set up the table, refer to the IRR, and this is a little bit, data tables are kind of hard to explain in a slide, but you basically set up your table with all your prices. Then you go back to this, and this cell that I have in gray refers to, it's equal to this cell, the 7.99. So basically you're putting in a formula. Then step 2 is to highlight the entire table from the word prices to 7.99 all the way down to 80 and 80. And then you hit data, what if, data table, and then you refer to the cell that you want the values in the columns to go into. So basically what you're saying to Excel is take these prices, these negative, and I put them in as negative because they're prices, that's what you're paying for the bond. Take this 100, take this 95, take this 90, and go back and put it in this cell where the 95 is. And so Excel will do that, and it'll spit out a table that tells you, based on a price of 100, a price of 85, a price at 80, what return you're going to get. And so I use this a lot because prices in the market fluctuate. So you want to see, I may not be interested in the bonds at 95, but they could be real interesting at 80. One last thing is a data table with 2 variables. So I use this all the time, more than the 1 table variable, where I have an EBITDA and an EBITDA multiple, and this is what the enterprise value is. Now, there may be, usually you use a range of EBITDA. You don't know for sure whether the company is going to spit out 225 in EBITDA, or 230, or 119, or whatever. And the multiple is usually a range. Like you rarely see analysts say, oh, this is a 5 times company. Sometimes they do, but usually, hey, this is a 4.5 to a 5 times company. This is the company that should trade at 5 to 6 times. So you want a data table that varies both of these things. So you set up the table. And you, this right here, the 1125 refers to this enterprise value. So you have to put that in as referring to another cell. So you set this up first, and then you set this up, and that gray box refers to the calculation that you did before. Then you can vary the multiples, you can vary the EBITDA. Step 2 is you highlight the entire table, data, what if, data table. It asks you where you want to put the 225, where you want to put the, where you want to put the EBITDA numbers. Where you want to put them is in the rows. So in other words, the stuff that's in the row, the 200, the 225, and the 250, you want to put it here. The stuff that's in the column, right here, the 4, the 4.25, all the way to 6, you want to put that right there where the EBITDA multiple is. So basically what you're telling Excel is where to put the values in the columns, and then the values that you have in the rows, where to put those. And then Excel will automatically fill out this whole table. So if you're talking to your boss and you're saying, look, I think this company is, think these guys are going to do 225 in EBITDA, and this is a 5 times multiple company. And he says, yeah, I don't know, or she says, yeah, I don't know, I think these guys are going to do more like 200 million in EBITDA, and the right multiple is 5.5, then you don't have to do work over again. This table spits out exactly, and you can change the inputs. It spits out exactly what the enterprise value would be. So I use data tables more than anything else, probably other than IRR. And I'm done, Adam. So if anybody has questions, and look, if there are any questions that I can't answer, shoot me a message on, on LinkedIn, and, I'm happy to try to answer your question that way. But the caveat, I'm not an Excel guru, but I'll be happy to try to answer your question.
Great, thanks, Shelly, and appreciate the presentation. As Shelly mentioned, you can find her on LinkedIn under Shelly Lombard. She has some good content there, and she's happy to connect with all of you. Shelly, appreciate the presentation. Not only are these great formulas for people to know, but I think that these are very practical applications. So thanks for that, Shelly. Let's see. So if there aren't questions, I think we should, it's a good place to wrap. We're at 50 minutes. Again, for those of you who weren't at the beginning presentation, this is Adam Ring. And if you did like the presentation today and you like Shelly, you can find her in our upcoming program, ICCF at Columbia Business School, which starts March 2nd. So hopefully you guys will take a look at that, as well as our program M&A at Columbia Business School in mergers and acquisitions. Both those are great programs, accredited by Columbia Business School, all led by Columbia faculty, as well as great teaching instructors like Shelly. So with that, we will wrap today. I want to thank everyone for joining. Shelly, thanks for your time. Hope you enjoyed it.
Enjoyed it. I always do.
Awesome. Great. Well, Shelly, thank you. Have a great holiday. And everyone for joining, have a great holiday. Thank you for being with us for this past hour.